So for these listeners, what would you say are the emotional intelligence or the wisdom of is it their discipline? Is it their ability to?
Okay, well, more important than the emotions are the quantitative things. For one, don't put yourself in a position where you'll be forced out because you get in over your head, whether it's on margin or it's the normal fluctuations during a day.
This is a special SteadyTrade podcast today, folks. First of all, I'm riding solo. My co-host, Stephen Johnson and Tim Bowen, weren't able to join in this recording and interview today, but we have a really special guest, and I think you're going to love this episode. I met Victor Niederhoffer 10 years ago at New York City's Junto meeting. Victor is one of the most fascinating and interesting people I've ever met. He's a legend in finance and a true genius, and yet extremely down to earth. I attribute that actually to him having been born in Brooklyn. Having been born in Brooklyn myself, I can tell you that you don't last long in that borough if you're not authentic. Brooklyn requires of you to be kind of on the razor's edge of confidence and a little bit of bravado and humility. And Victor, I think, exemplifies both. Victor started out trading futures and options since 1979, and he began his business career after studying statistics and economics at Harvard and the University of Chicago. Victor became one of the top financial advisors in futures, options, and stocks, and George Soros actually says in one of his books that Victor was the only one of his managers who retired voluntarily from his fund and still ahead. And in fact, Soros had sent his son to Victor when his son decided to go into finance. So Victor's firm returned 35% a year from inception through 1996, and he was ranked then as the #1 hedge fund manager in the world. But disaster struck the next year, unfortunately. And as he likes to say, he has this famous kind of quip that he responds to that time. He says he's been crawling his way back up the stairs, not entirely without success. And I think you'll see that it's a lot more than just not without success. Victor's also the co-author of the book Practical Speculation, but his first book, The Education of a Speculator, is my favorite, and it shares his life story, his mindset, and his tips for studying the market, along with his love for his father, who was, just has such a big impact on him and his life. It's just a really big book, and it's just a wide and scope of so many of the ways he looks at the world. I think you guys really will take it. It's quite a book. So Victor is 77 years young, and his depth and his breadth of knowledge is truly staggering. Every time I'm with him and in conversation, I've known him now about 10 years, I feel smarter just having had a couple of conversations with him in a room, and I'll walk out and feel like my mind has expanded. So I think you'll find the same. He's been in the markets for 55 years. In this interview, you're going to see him say things that might surprise you, and in fact, you might not even agree with. In fact, it's different perspective he has than what we here at SteadyTrade and StocksToTrade advocate. But we here believe that it's really important to be exposed to multiple perspectives, even if we don't agree with them, even if you don't agree with them, because it can only inform you at being able to discover your edge and the kind of trader you want to be. Everybody has to be that kind that has to decide that for themselves. So this is a big part of what, out of everything I've learned so far, as you guys know, I'm a baby trader, everything I've learned so far from Tim Bowen, from Stephen Johnson, from Tim Sykes, all of them are telling us, yes, we have to study our asses off, but then we also have to find our style, what's compatible to our temperament. And if Victor Niederhoffer is an example of anything, he is an example of being a man who is true to himself and to his lens of the world. And while he takes in all this other information, he still makes his own decision for himself. And I hope that this interview does anything, it inspires you to become the trader you need to be for yourself. So first of all, it's good to see you. It's been quite a few years, sir.
Yes, thank you very much.
It's good to see you. We've already started to record. So, this is just a casual conversation, Victor. I want you to feel really like we can talk about the different topics that are important to you. Reason I thought of you in the first place, besides you being a legend, is because I wanted your, one of the books Tim had picked in our book club series was The Fountainhead. And he felt that was a really important book for traders to read. And so he suggested, that as a book. And I thought, well, who would I want to talk about that book? And I thought of you because of the times we spent at Junto. I know you love Rand so much. I love her so much. So that's the reason I invited you to talk about The Fountainhead. A little bit about why you think that might be valuable for traders, but also to just share whatever you think might inspire or encourage our audience of day traders.
What is your audience?
They are, for the most part, a demographic of young, probably male day traders.
How did you get in contact with them?
Well, these day traders are the viewers of this podcast, so we'll be speaking to them.
Well, I think the day traders might be more interested in my views on the stock market.
Well, that's what I would like you to do, is speak of that as well, obviously. So it's a combination of things today.
Mm-hmm. First, I'd like to say that I would recommend reading Atlas Shrugged as opposed to The Fountainhead, because the virtue of the stock market is that you're developing a piece of the American business enterprise, and you're investing in business enterprises. And if you want to know how a business enterprise runs and why it's important for it to be free to develop its products and market it, and why that's a value as opposed to the government controlling capital. It's first mainly important to read Atlas Shrugged, and then to follow that with the Triumph of the Optimists.
Okay.
Now,
and what's that book?
The Triumph of the Optimists and his two collaborators shows that an investment in the stock market from 1900 to the present would have about a 50,000-fold return. In other words, if you put in $1 and you indexed it, it would come to 50,000. And the reason that it comes to 50,000-fold return is because by investing in the stock market, you're participating in the enterprise system and all the know-how that individual entrepreneurs and business corporations make to try to make a profit and you can participate in it. You're basically lending money and buying a piece of their enterprise. So
Yeah.
the returns from the enterprise are given in the book Triumph of the Optimist by Dimson, Marsh, and Shallow.
Okay.
The Storm.
That's awesome. It's not a book I've heard of before, so that's a book I'll definitely read.
Everybody should read it. It's the most important book written about the stock market, and it's a good antidote to all the baloney that's written. Many people have read my book, The Education of a Speculator. It was a bestseller, and many day traders come up to me and say, I really enjoyed your book, and the only book that I find comparable to it and that I enjoy as much is Reminiscence of a Stock Trader by Lefebvre.
Is that Jesse Livermore? Is someone?
Yes, but that's the greatest insult to me, because in addition to certain books that you should read, that book is the worst book to read because it's a lesson in failure. He empirically and theoretically, Jesse Livermore, before he committed suicide, was and bankrupt 5 times, and all of the lessons that he talks about in his book, which seem so apt, are highly destructive. And I would recommend, first of all, that you read John Markman's updated edition with historical notes on the Reminiscence of a Stock Trader. And then you should read my review in Barron's of that book to know why you shouldn't read it.
Okay.
And actually, the reason you shouldn't read it is because he was bound. It's not only that he did fail. And by the way, if any of your day traders are in New York, I would recommend that they always walk across the street when they pass the Sherry Netherlands, because that's where Jesse Livermore committed suicide.
Oh my God.
And, that's on about 62nd Street.
Wow.
In Central Park, East.
Oh, that I didn't realize it was out the Sherry Netherlands window.
Well, the reason he failed is something that day traders should keep in mind. And in fact, they should relate it to what I just said about the triumph of the optimist. If you can make 50,000-fold return on by buying and holding, then there's a wonderful engine that can make money for you. But when the reason Jesse Livermore failed, by the way, my grandfather used to trade with him.
Really?
Oh yeah, grandfather Martin.
Wow.
And, he in those days, commissions were about 4 or 5% on for a round trip, and the bid and ask was about 3%. So that by the time you got into a stock, you were down about, well, let's say 5 to 10%. Now, in addition to that, he traded frequently, and he traded on margin of about tenfold. So he started out down about, let's say, 5 or 10%, and then a 5% move would put him down 60%, 10 times 5% plus the bid ask and the commissions. Now, your friends, the day traders, might think that because they only pay $2 aside rather than on a typical $100 stock, which Jay Livermore paid $4 or $5, they might think, well, they don't have to worry about the reason that Jesse Livermore was bankrupt 5 times. But actually they do, because if you're going for a 2-point profit on a stock and you pay 25 points for the bid ask, then you're basically giving a VIG of 12.5% to the house. Now, when you play in Las Vegas, there are a lot of games that you can play where you only give 2% to the house, and you know that the house never loses. So if you're playing a game where you're taking out small profits, as most day traders do, you're bound to lose. Now, in addition to that, you have people with better access and better infrastructure, the high frequency boys.
Yep.
So that in addition to taking out 25 cents on each trade, they'll take out another, let's say, 12 cents, so that you're really playing with a 15 to 20% VIG. Now, if you're doing that often, you're playing a game where the house, whether it's poker or roulette or sports gambling. An interesting thing is that the sports gamblers, who are akin to the day traders, only have to win 52% of the time to break even. So in a sense, they're giving VIG of 2.5%. That's what it works out to when you take the bid ask and the house take. Now, a sports bettor very rarely can win when he's paying a 2.5% VIG. Everybody, I'm sure, knows what VIG is. That's the amount the house takes, and that's why Jesse Livermore went bankrupt, because he gave away. And fortunately, the brokerage houses knew that, so that when he went bankrupt, they would give him another stake, and they'd let him play with their money, and he'd then lose it all in commissions and being forced out through margin.
Wow.
So day traders should try to ride along with the drift, with the old man river. I like to call it. They should. That's a good song to play in every day trader's office. Because Old Man River lets you participate in the 50,000-fold a century drift, which, by the way, Dimson, Marsh, and Staunton update every year. Of course, now what I'm saying seems inopportune, because the market's down about 15% from the beginning of the year. But it's been down 15% before, and the 50,000-fold a century return has been consistent. Almost any 10-year period you can expect, with a variation of about a standard deviation of about half the mean, you can expect 25% of the time you'll make 15%, and 5 or 10% of the time you won't make your 10% a year return. You'll actually lose. And by the way, a day trader should be thinking about, and he should have the Standard & Poor's Security Price Index record with him, as well as access to Yahoo or Bloomberg, which gives the returns from all from stocks from the time they began taking statistics from about 1897 to the present. And they should all look at what, we're in a bear market. Now, is that supposed to scare you? I mean, what happens during bear markets when a closing price of the S&P is actually more than 20% below a previous high closing price? By the way, you can't use within day prices, because a lot of times within the day it will be down 20%. By the time the end of the day, it won't be there. So people who actually create the statistics on bear markets make the error of only counting the times that it intraday goes below 20% and stays below 20%. So there's a tremendous bias. In any case, the first thing that a day trader should do is to say, now, what happens when the market is down 20% from a prior high? Is that bullish or bearish? Well, take out the pencil and paper. And by the way, that's one thing that I'm very famous for, and that I've taught to a lot of people. They should always ask, whenever they hear something that seems sensible, have you tested that? Have you taken out the pencil and paper to see whether a bear market is bullish or bearish? I claim that when the market has gone down 20% from a previous high, you have to be exact, because many of the previous highs were up 10%, 15% on the year. Just like now we're about where we were in May of 2020. There's a big rise in December and a big rise in January. So when you take a move from a subsequent high, naturally it's going to appear as if it's enormous in extent.
Victor, let me just ask you a question. Just now you said May 2020. Did you mean May 2019?
No.
Okay.
Maybe. Yeah, 2019.
Okay. So please continue.
Okay, so day trader, don't go for small profits, and minimize your VIG, minimize your turnover during a day.
You're advocating that day traders should not go after small profits?
Correct. That's correct. They should take a position and hold to the end of the day. And if possible, they should hold to the next open, but that has to be tested depending upon what stocks they're buying or selling. Mm-hmm. But they're not gonna possibly make money if they're competing against the high frequency boys and the bid ask of 12.5%. So they're playing a losing game. I know a lot about it. I'm sure your listeners know that also, because many of them follow sports very keenly.
Yes.
And there are sometimes you get against an opponent and he loves the way you're playing because you can't win.
Yeah.
For example, you're playing a baseline game. You're staying back against Nadal. You can't possibly win. Of course, my background is from handball and squash and
Sure.
and I used to play someone like Marty Hogan in racquetball, and I had, even though I was ranked in the top 10 in racquetball, I had a slice backhand. So he would hit the ball about 120 miles an hour, and I'd be hitting it about 50 miles an hour. There was no way I could win, although I did beat him the first time we played.
Well done, well done.
Now, in squash, it was a little different. When people played against me, they had to know that they were playing a losing game. I could return every ball on the court, and I never made an error. I played an errorless game. So if you think about it,
it's winning. It's a winning. It's still a win. You may not have won the game up against those, but you still won.
For 10 years, I was basically I was the national champion. I didn't compete for 5 of those years, but I won the national championships 5 times. And the only person that could beat me was Sharif Khan.
Wow.
And I played a losing game against him because he hit the ball earlier than I did. And I don't like to think about the reasons that I lost to him 70% of the times. Okay,
so
now,
Victor, here's a question for you. So if the majority of our listeners are day traders, and they are especially dealing with, this, what's your opinion on the place we're at now with the market? What's the, not so much prediction, but what's direction you feel you see it going over the next 6 months?
I predict the market every day. So you've asked the right person.
Okay, good.
Developed the major method of predicting the market. And I've had so many people who have taken my methods of predicting and now use it. I'd say half to 50% of all the trading platforms use my methods of predicting, which is that they look at the intraday prices, the relations of one market to another, and the statistical frequency of returns and variations given the regularities, which will vary by day of the week. Now, you asked me about a book that should be read, and I recommended Atlas Shrugged. I'd also recommend the book The Secrets of Professional Turf Handicapping by Robert Bacon.
Okay.
And you'll find a good discussion of that on the internet. In fact, since I recommended the book, it's very hard to get.
Wow.
A good library has it. But anyway, in that book, you'll see someone who understands speculating. And he develops the theory of ever-changing cycles, which basically means that whenever you have a method of profiting in life of the markets, that the other side will adjust their positions so that the method that you were making profits stops working. And he gives an example in a typical horse racing outing of 4 different systems of making money that start losing. And it's once you read that, it's very revealing, and it's also very important for day traders. They're making money the same way a few times. You can assume that it won't work. I like to use the example of the crocodile hunter in Australia.
Mm-hmm.
The crocodiles don't eat daily. They sometimes, the average duration of their dining is about 3 months.
Wow.
But they have a tremendous memory, so that if a crocodile sees you fishing in a certain place, chances are that will be on one of his fasts, and that he won't jump in to kill you. However, he'll remember exactly where you were the last time you passed him, and 3 months later, he'll be ready for you. So the crocodile hunter knows never fish in the same place twice.
Wow.
For example, today in the market, as most of your traders would know, we're talking on Wednesday. The market on Tuesday went down 30 points from 345 to the close. So today it did so the people who don't hunt crocodiles were thinking, well, maybe it will do the same thing again. So instead of going down 30 points, it went up 30 points. And that occurs in every aspect of the market. It's a principle of, well, one of the rules that I give day traders is never try to make the money the same way twice. It's also a variation of the principle of ever-changing cycles, which you can find.
And today is April 8th. And today is April 8th, 2020, everyone. So you can, just so they have context, Victor, with what you just said.
Very good. What else is on your mind?
Well, I'm just curious if you feel, what would you say are the top 3 important things? My focus in this podcast all the time is around the emotional intelligence. So for these listeners, what would you say are the emotional intelligence or the wisdom of is it their discipline? Is it their ability to?
Okay, well, more important than the emotions are the quantitative things. For one, don't put yourself in a position where you'll be forced out because you get in over your head, whether it's on margin or it's the normal fluctuations during a day. And then second, don't pyramid during the day, because that leads to two problems. For one thing, the principle of ever-changing cycles means that if you keep trying to make money the same way, you'll lose. And the adversaries, either directly or indirectly, have a way of knowing exactly what you're doing, no matter how small your trades are. The infrastructure will stop to take your money away. It's hard to believe that, if they see a way for example, in options to make a $10 million profit, that is enough to steer the whole market against you. So a good way of thinking is that there's an invisible evil hand that knows exactly what your positions are, and that will always be ready to force you out when it's in their interest. Now for the average day trader, they're only going to make $50,000 or $25,000 by forcing.
And Victor, most of our listeners are actually looking to make a lot less. The day traders that we are actually, speaking to, for the most part, are looking to make sometimes their entire account. Like Stephen Johnson, one of our co-hosts, he starts out with only $800, and he takes that, and he's lately been able to turn that into like $5,000, $8,000 a month. So most of our day traders are doing this with small amounts. Some of them are doing much larger, obviously, but we're the advocacy in this podcast with SteadyTrade and StocksToTrade, and even Tim Sykes, the one of the educators of all this material, speaks to making small profits consistently over time.
That's completely wrong. I'm glad you mentioned that. That's a lesson for certain failure. To take small profits that maybe you're dealing with a 30-minute window or 2 hours, and you're competing against someone who plays a better game. You're competing against the high frequency tradings who are always going to run in front of your orders. If you put a limit order in, they'll be right ahead of you. And if you put a market order in, they'll hit the bid or ask. So you can never make money by playing against someone who's better equipped. We spent $1 million on getting better access and why is it that the high frequency traders some of them for 10 years have made money every day? Because they're competing against the proverbial day trader. Now, what other rules have you felt would actually help your day? Of course, the problem of being margined out is very, very conducive when you start with a few $1,000s. You buy 100 shares of a stock, and most of your day traders use a lot of leverage. So if it moves, say you're using 5 times leverage, you're subject, if the market goes 2% against you, you've lost 10% of your money already. Now you can't do that too often and stay in the game. And certainly as a method of speculating to start out with I said 15% vig, and then letting a 2% move, which is say occurs once every 2 days in stock. Nowadays you're getting 5% moves. Right. So if you're wrong on a 5% move with 5 times leverage, you've lost 25% plus the 15% vig. And then your boss is going to say, there's no, you have to come up with more margin.
Yeah.
Go
ahead.
You know,
What do you feel what do you feel the kind of personality, is there a certain kind of personality or temperament that you think is better suited to day trading than another?
Yes. The best day traders are very phlegmatic and calm, and they take a long-term view. They're not ephemeral traders at all. They don't try to take small profits because they know it's a losing game, and they try as much as possible to participate in the drift. The best traders are scholarly. They don't trade based on whimsy or fancy. They trade based on tested methods.
And the tested methods you have, Victor, are those tested methods that you were mentored in, or these ones you created yourself over time?
I created them myself. Yeah. In fact, I wrote the first program that takes account of the intraday movements of all markets and how they vary in their predictive powers by day of the week. But hundreds of my colleagues who have worked for me have now taken those methods and they use it in their own trading with much more capital than I have.
Yeah. What do you think is the next 3 to 6 months in the market? What do you see coming this next year?
Well, this is a very good time to buy and hold. There hasn't been a 20-day high in about 60 days. And that's happened about 12 times in the last 10 years. The duration without a 20-day high. There was a 17-day high, but not a 20-day high. And if you test what happens when there hasn't been a 20-day high in such a long time, you'll find that the expectation to the next 20 days is about 10% up. Now, of course, there's a lot of variability to that 10%. Maybe the standard deviation is about 30%. But 9 out of 10 times, you'll make money at a time like this now. You might say, well, this is a very different kind of market than any other. But no, there have been times in the last 20 years when the market has been just as bearish as it seems right now. And most of the time on an expectation and a Sharpe ratio adjusted fashion, you make money by coming in. So another thing I would advise against is shorting stocks. That's very bad.
What do you not like? What do you not like about it?
Well, it's a lesson for disaster. About every 2 years, the last short seller cries uncle and he gives up. And George Soros has said he's lost more money shorting stocks than any other way.
Wow. And
you have to, I don't know any short seller. I've only been trading for 50 years, actually. 58 years. And wow. I've never met a person who was a short seller who made a profit. And invariably, every 2 years, the last short seller will close his fund.
Mm-hmm.
Now, of course, the short sellers look very good right now because
Yes.
they happen to have caught one of those 10 or 20% swings. But by the way, if you go long every time there's a correction in the market at 10%, that's a great time to go in. In other words, when the headlines are glaring correction, market is in a correction, this one or that one, that has to be tested. But you'll find that on average, when it's down 10% from a previous high, that's usually a very, very good time to take a position. Now, as to the 20%, there aren't that many instances that you can actually test it. But there probably only been 10%, 20% corrections in the last 25 years. So it's hard to do a statistical comparison. And by the way, you were telling me that Ayn Rand's books are very good, but
yeah,
here's another one that's very good.
Okay, let's see it.
Everyone should.
The new statistical analysis.
Everyone should have a good background in statistics for trades.
Okay.
Whether it's a formal knowledge or a practical knowledge. But here's a very good, it's an elementary book. The New Statistical Analysis of Data by Anderson and Finn.
Okay.
I have other good books. I have the Speculator's Reading List.
Okay.
I have in addition to reading Atlas Shrugged.
Mm-hmm. And the Optimism book, what was the title of the
Triumph of the Optimist.
Triumph of the Optimist. Got it.
That's right. And now any book by Andy Gull is very good.
Andy Gull, Gull?
Andy Gull, L-O. Yeah. Or by William Gottsman.
Okay.
He's a professor at Yale, and Andy Gull is professor at MIT.
Maybe you'll email me.
Everyone should have a good knowledge of economics who trades. In fact, when you ask me what kind of emotion is best for trading, I'd say a scholarly emotion is the best for trading. Someone should be interested in books and should be always trying to learn new things. And whatever the field, as I happen to think that ecology is very important for speculation. And
I think of your book, Victor, the Education of a Speculator, the story that's in there, and please remind me of the details, but how you allowed the environment and different things that you saw by way of cigarette butts to influence just your understanding of the, kind of where the milieu was for the people out in the world.
Much more than an axe as to a little thing that you can find, but
right.
It's a role that you play in the feeding web, whether you're providing food to those above you or taking food from those below you. Now, unfortunately, a lot of the questions that you've asked have related to the day traders being food for those with more resources. And that happens Now, by the way, another important book, which a great professor recommended to me, he said it's the most important book ever for the stock market, is Ben Green's Horse Trading, and he shows all the deception and all of the methods that the horse traders who are very big in the West and all the methods that the horse traders use to urge their buyers to buy at the wrong time and to give them bad merchandise.
Mm.
And so that's a very good book to read.
That's awesome. That's awesome. Maybe these other titles, I think we're gonna.
What? Ben Green.
Ben Green.
Ben Green.
We're probably gonna close up the conversation soon, Victor. So is there anything else that you would want to say or leave with the viewers around?
And instead of reading The Fountainhead, I would recommend reading Elmer Kelton's book, The Time It Never Rained.
The Time It Never Rained.
The Time It Never Rained.
Okay.
A book that's similar to Atlas Shrugged, and it's by someone who really knows his field. He was the goat, sheep, and cattle reporter for the San Angelo papers for 20 years. And he's by far the first or second best Western writer. So I'm sure all your day traders are interested in good Westerns. He's far superior to Louis Livermore.
Wow.
They'll get such a feeling of knowing what's happening and of foundation for living by reading that book. And the hero of that book is very similar in many ways to Dagny or John Galt. Another good book by him. And by the way, the Western writers have an annual competition where they give a prize for the best book every year. And Elmer Kelton has won that. They call it the Spur Award, has won that about 7 times out of 20 years that they've been having it. Another good book by Elmer Kelton is The Good Old Boys. And you learn about a person who's independent and who understands the forces of life that are against him and refuses to bend. But by the way, I say it's only the first or second best Western. I think the best Western might be Monty Walsh by Jack Schaefer.
Wow.
Anyone who reads that doesn't come away with an appreciation of how the new has to be adjusted for, and how everything is always changing, and who doesn't come away with a deep feeling of appreciation for the old cowboys, and who doesn't cry.
And this was Monty
Walsh, M-O-N-T-E.
Monty Walsh. Got it. Monty Walsh.
By Jack Schaefer.
That's awesome. Victor, thank you. Thank you for your wisdom. Thank you for your amazing book, The Education of a Speculator.
I don't know that I've had much wisdom, but don't want to lead your listeners down the primrose path. And
I get that.
That's why I've told them the way it is. But as you say, I've only been trading for 55 years. So
55 years. In my opinion, that is a long time.
You know, the most famous book in the field is my years of 50 years of trading in Wall Street. But I've been trading 55 years.
It's 55 is an incredible amount of time. I wish we had more time, because the things you've seen and the things you have lived through have got to be extraordinary.
I wish I hadn't lived through them. Okay, thank you very much.
Thank you so much, Victor. I appreciate you coming as a guest. It was really good to see you.
I have to go back to trading tonight.
Yes, exactly. Thank you,
Bye.
Victor. Aloha.
Bye.
Good to see you.
Good to see you.